All right. We're going to go. Today is November 30th, 2023. My name is John Kerrigan. I moderate the BYOB Trading Room, along with many others that also participate. I love it. All right, so we're going to go hit the SPY first. So I just want to set this up. So you can see SPY is hitting a weekly downtrend line. This is for all the people that don't know where we are, but this is a chart of the SPY on the daily chart. This is a weekly downtrend line. And what we have is SPY's kind of dropping in here a little bit. So I smell a little bit of weakness in the water here. So what we're going to do is we're gonna short the SPY, but in order to short the SPY, we're going to, let's see what we're gonna do. We're gonna do a bear call credit spread. All right. So, but we're gonna put our bear call credit spread a little bit higher, maybe about 460, 462, probably about 460, and the spread will be 464. All right, so we're going to do it like that. And I was going to do the SQQQ, but I'm going to just do the SPY. So we're going to do a bear call credit spread. And we're also, in addition to the premium that we get with the bear call credit spread, we're going to take the premium and buy an out of the money put. Okay, so that we're going to cap off our downside, but leave, or we're going to cap off the upside, okay, but leave the downside as unlimited in case it wants to come all the way to 410. So this is the strategy. Okay, we're going to go to the options and pull up the options now. Coming up. So here's the options chain. And I want to do this for, well, let's just say I want it done on whatever when's triple witching. You guys know when triple witching Thursday is? Anybody know? I think it's, let's see what Thursday it's going to be. It's usually the third Thursday in December. So this would be the first, second. Triple witching is going to be the 22nd, right? Or is it the 15th? It's the 15th. Thanks, Ricardo. So we're going to do this for the triple witching the 15th. All right? Because a lot of crazy stuff happens then. So we're going to go out to the 15th. And we're gonna buy a bear call credit spread. All right, and we want it to be, let's just say 460, 462. Okay, and that's gonna cost us. We're gonna collect $1.33, and we're gonna sell. We're going to sell the 464. We're going to buy the 464 and we're going to sell the 462. All right, so that's going to give us a premium, okay, of, let me just use my calculator because my brain is thinking so many things right now. Usually I do this in my head in a snap. Okay, it's 30. Okay, let's say 33 and 7 is 40 cents. So it's going to give us 40 cents. And with the 40 cents, we're going to go find an out of the money put and buy that. All right? So now we're going to come down all the way down to the puts. Same expiration date. And we're going to find an out of the money put which is that we can get for 40 cents. Wow, 137. Well, you know what? Let's try something a little bit more reasonable. Let's take, you know what? We'll do 10 of those and 5 of these. That way we can buy something different. All right. And we're going to buy half as many of these 436. All right. We're going to buy half as many 436 out of the money puts right there. And we're going to see how that works out. All right. So I'm going to sell 10 bear call credit spreads. I'm actually going to place 10 bear call credit spreads, and then I'm going to buy 5 of the 436 puts. All right, now if price starts to drop down, these puts will rise. And that's what I'm going to do. Okay, so that's the strategy. Now, typically you'd buy the 429 puts. No, the they don't even have it low enough. 440, the 428 puts. That's way off. It's off the charts. Let's go out a little bit further. Maybe we don't do triple witching. Let's try something a little bit closer. You know what? Let's just do one of these and see how it works out. Okay? Let's just do one of those and just see how it works out. We'll get the 428 put right there. All right? So just as a strategy, I'm going to do it right now. So I want this one, the 15, right there, and I want the calls. And then this doesn't cost us anything. And for the calls, I wanted the 15 DTEs. And I was going to do the 462s. You know what? If I went a little bit closer, I could probably capture more premium. You know what I'm going to do? I'm going to do the 456 by 459, and I'll capture 456. So that'll give me 342, and I'll have one. I'll do the 460, 342, subtract 188, gives me $1.54 to play with. All right. So I'm going to do the 456, 460, and then for the put, I've got $1.54 to play with. So we'll go down to triple witching, and I can find a put for $1.54, which would be this one right here, the 443. So now I've bought a put with the premium that I got. And that's what we're going to do. We're going to do one of those. So I'm going to buy this put right now. And I'm going to buy it at, well, 154. So buy one put at the bid. And this doesn't cost me anything. Okay, so I just bought one put right there. One of the 443 puts. All right, in case market just tanks on me. All right, now, okay, I'm going to go up and do my call spread. All right, and what did I say? 15 days. And we're going to do the 456 is what we're going to sell. And we're going to go long the 460. So here's the 460. You want to buy one of those at the bid. If I can get filled. Yeah, 15 DTEs. So I'm waiting to get filled. All right, so I sold the call, so it's naked right now, but I gotta buy one. All right, so I don't have naked. All right, we got one. All right. No, I didn't want two. I only wanted one. Yeah, okay. So I got to get rid of this. I got to get rid of one of them. All right, which I need to do now. All right, it's gone. All right, so now I've got. So let's look at the strategy here. Okay, so we've got. Where'd my calculator go? Okay, so we've got one call, and the entry was 186. And then the other call was 343. That gave us $1.57 to play with. And then we took the $1.57 credit and we bought $443 out of the money put with it. Okay, so we've got like unlimited downside. Unlimited. If the market drops, okay, we make money on the call spread instead of being capped off. And I probably could have gone a little bit lower, which would have given me even more money. I probably could have gone here and here, and that would have given me even more money. But anyways, that's what it is. So this doesn't cost us anything as long as price in 15 days closes below 456. All right, so we're going to try this out and see how it works out. So we got unlimited downside, but we've got $4. What's our risk? We're exposed by $4 times $100 times 100 shares. 100 shares times $4. So we're exposed for $400. And we have unlimited downside. So we're going to see how this plays out. All right? And it didn't cost us anything to have unlimited downside. I didn't take delta based on anything. I just wanted the spread to be $4 wide so I could capture enough premium to buy a decent put out of the money put. Because if price goes over, closes over if price closes over 456, I will have to owe them money. And my next call, the one that I bought, was 460. So the difference between 456 strike and the 460 strike is $4. So $4 times 100 shares leaves me exposed for $400. But that will be my max loss. But I will have unlimited upside to the profit, but my max loss is 400. You see how I capped it off? So we're going to try this and see how it plays out. And it didn't cost us anything. Well, that trade didn't cost anything in reality to my buying power. You notice that? I'm just exposed for $400 worth of 400 minus the credit I got. Well, I used the credit and bought a put with it, an out of the money put. Thanks, Mike. So in actuality, I placed a trade that was a free trade. You know what I'm saying? I placed a free trade. It didn't cost me anything. All right? Now, when it closes, if it closes over 456, well, then I got to pay up. I'll have to pay the piper. Exactly, Melinda. Free unless it goes over 456. Free unless it closes over 456, right? It's free unless it closes over 456. Now, think of if you did the bull put credit spread and bought out of the money calls, okay? And you did that at, let's say, 415 3 weeks ago before the market took off. You know what I'm saying? Think about that. What if we did the other side 4 weeks ago? Back when SPY was down here, and then we bought, I don't know, out of the money calls way up here, like 430 for like 20 cents or whatever. Think about that. Here's a free trade right here it was anchored VWAP right there. Is market dropping? Good. All right, so that's a free trade. So if I'd have bought bull put credit spreads here, and I don't buy them, I place them. you place bull put credit spreads, and then in 2 weeks, you've got let's say you got 431 calls, and the market closes right up here at 440. Think of how much those would be worth, like $900, right? If you bought 431 calls, it'd be worth $900 because if the market closes at 440, and that trade wouldn't have cost you a dime right there. Placing bull put credit spreads and buying an out of the money call. See that? And you could have gone out even further, but who knew? Who knew, right? I sure as heck didn't know. But that is one strategy when you see a big move coming that won't cost you a dime of your buying power to put that on. So there's just a little concept there I want you to take away. I've got it recorded so that you all can look for opportunities to use a strategy like that doesn't cost you anything, where you have unlimited upside and where you see the next move going. So there's strategy I wanted to share with you. And that's it. That's it for the lesson. But that's just a way of placing a free trade right there. And like Melinda said, it's free as long as price doesn't close over 456. So true. Yes, that's right, Robert. Yep.